We also want to look at just what that means for the banking industry and how it will affect even the people who are working in those particular companies. And on set with me on my immediate left is Maurice Odwor, an investments expert, as well as Ken Wachira on my far left, a commercial lawyer from Rodl. Welcome on set, gentlemen.
Thank you.
Maurice, I can start with you. These particular mergers that are ongoing, what do you think, or rather, how did we get here? There have been quite some mergers over the past 3 years, or suggestions of mergers. How did we get here?
If you look at Kenyan banking sector, I think two things have happened, and most of them coming as a result of the operating environment. One, it's becoming now almost impossible for institutions in the banking sector that have common shareholders to continue operating in this environment. A case in point, we saw the merger between the acquisition of a national bank by KCB, and these are two banks that we know the top two shareholders are common in both cases, the Treasury and the SSF. And we saw National Bank was really struggling in terms of capitalization. So we are seeing common shareholders becoming now a factor to consider when where banks are operating in this tough environment. So there was no need for these top two shareholders to continue providing capital to National Bank, yet they are again operating under another brand, which is now KCB. The only feasible and the only workable reasonable action was for the two entities to come together. Also, if you look at the same case, NIC, CBA, common shareholders coming together, two banks almost looking at the same segment in the market, is only again feasible for them to operate together, to operate as one entity. Also, we saw, I think it was early last year, where again we saw the Diamond Trust Bank and Habib Bank, again common shareholders, Habib Pakistani, operating in the same environment. It was only reasonable for them to work together to operate as one entity. But if you look at again going forward, we are likely again to continue seeing this because of the new reporting standard that also came in this year, where now banks are now supposed to adopt a more forward-looking approach in terms of credit provision, which now will have a significant effect in terms of capital adequacy. And now again, banks that are really going to find it difficult to operate will be candidate for acquisition by well-established big banks that are well-capitalized.
Right. Wachira, do you think that there's more to the reasons for these mergers?
Yeah, I fully agree with what Maurice has said. The only thing I may probably add is the consolidation of banks. At least these banks that come together will be more positioned to withstand external and internal shocks. We've seen the situation of Imperial Bank, Chase Bank and SBM, you know. So when such things happen, when banks are placed in receivership, tier 3 banks that have got less market share, normally go through turbulence because of such things that happen in the market when a bank is placed on receivership. So when two banks merge, at least they'll be able to withstand more shock, yeah, and more market changes. Yeah.
Okay, the banking industry right now, it's operating in quite some tough environment based on the interest rate capping and also the digital technology that is taking up the financial sector as well. So, Maurice, do you think that these have pushed some banks to re-strategize and even acquire smaller banks, so to say, or struggling banks?
If you look at post-rate cap operating environment has been tough for banks in terms of how they price in risk, and now banks are becoming more used in terms of the segment of the market they are playing in, and also in terms of security they are investing in. Preference has been more towards government instruments that are risk-free, also will give them leeway in terms of capitalization of the banks. But if you look at going forward, margins are becoming very thin. Banks that have no specific niche and they are not known for serving specific segments of the market well will find it difficult to continue operating. The struggling banks that can't be recognized by a specific segment of the market, those ones will either die off or they will be candidates for acquisition. And also, if you look at now going forward, the game change is going to be on digitization and automation, because as Warren Buffett once said that even in 100 years, we'll need banks. but not as the way they're existing currently.
Right.
If I ask you, even, I know you can't even recall the last time you visited a bank branch, but you are getting banking services anytime, any day you want on your mobile phone, on web applications. So that's where the banks are headed. Digitization, which may lead to job losses in terms of staff rationalization, and also banks to be able to be recognized by, to be known for serving specific niche that now they can take advantage of, for them now to be able to remain sustainable.
Right.
Just as Washira said, going forward, consolidation and this acquisition will result into very stable and banks that can withstand shocks, well capitalized, big banks that can even fund big infrastructural projects. Yeah.
Okay. Washira, he mentioned the issue of the interest rate capping. Of course, it has been tough for banks.
Yes.
And they've looked away from the SMEs. SMEs have found a way to survive, yeah?
Yes.
Of course, with the digital apps coming up and just lending money, of course, it's high interest,
Yeah, true.
but that is the place where they are accessing this money.
Yeah.
Do you think that if the banks do not adjust accordingly, digitally that is, they will be overtaken?
Yes and no. No, in the sense that, with formal banking, not digital banking or digital lending, banks are a bit more cautious on how they lend. Again, there's a personal relationship. So you find with digital banking, there's not a personal relationship. So even in the event of default, we've had instances where we've had this digital lenders, will call even your mother-in-law, demanding for repayment of that money, which is something that banks don't get. So there's that relationship, there's that listening ear with banks. But on the flip side, when it comes to digital lending, you find the requirements are not as stringent as what banks offer. And again, now with the interest rates being capped, you find it was meant to create access to credit, although it has had an opposite effect, but at least there's that opportunity for SMEs to approach banks and get lending. And it doesn't necessarily have to be digital lenders that SMEs turn to. They're also microfinance and circles. Yeah, so that's also an option.
All right. Yesterday, when Parliament was discussing the banking bill, of course, which is fronting, or rather which is the interest rate cap is part of, one of the arguments that was put forth is that the bankers are twisting government by not lending to SMEs, not that they really can't lend to SMEs. What's your comment on that, Maurice?
I don't think it's twisting as such. And if you look at the mistake, the idea behind interest rate cap was a noble idea. But if you look at where we are now, almost 3 years down the line, nothing has been achieved. The law has not lived up to its intended objectives. What it has done is stifling private sector of credit. So if you look at where we are, banks are even finding it difficult to fit everyone within the 14% band. People have different risk profiles. So it's not twisting, it's that we took the wrong approach with how we price money.
Okay.
We can't price money the same way we say we price tomatoes, ungas, and all those things. Money is a special commodity. When you want to price money, elements of pricing risk comes in. But we can't say in an economy like Kenya, the maximum risk profile, maximum risk premium is 4%, which was put above the policy lending rate. So the issue has been the mechanics, the mechanical way in which you are addressing the issue of access to credit. The idea was noble, it was very good, but the law has not lived to its objectives.
Right.
Yeah.
Of course, we'll watch to see how that goes. But on the issue of mergers and acquisitions, the experts foresee that, of course, there'll be job losses with these mergers that are ongoing. What impact do you think that will have in the already struggling employment sector? I mean, there are no jobs. Now you're sending more people into unemployment.
It's true, but the procedures when it comes to mergers and acquisition, one of the things that the banks have to comply with is rules set by the competition authority. And before the competition authority can allow such a merger, you have to demonstrate to the authority that the merger will not result to job losses. So ideally, the mergers should be structured in such a way that there are no job losses. But unfortunately, we find at times mergers occur to cut operating costs.
Yeah.
And this costs may include manpower. Yeah, it's unfortunate that jobs may be lost, but in my view, the parties should structure this merge as well so that there are no job losses. Because again, as I said, it's a risk. You risk not getting the transaction approved by the competition authority.
Right. But even aside from the mergers, of course, you said there's a procedure.
Yes.
But in the last 3 years, the data has it that the staff size in banks has shrunk by about 6,000 employees. That means there's cutting costs is very important for the banking sector. So that means jobs are being lost. Jobs will continue being lost. Maurice?
If you look at, there are two ways into looking at the issue of job losses in the banking sector. One, which Wachira has also mentioned, this as a result of mergers and acquisition. Then on the other side, even if you remove merger and acquisition from the scene, there's also just now banks trying to rationalize their mode of operation, especially post-rate cap. So that's where now banks are. Even without merger and acquisition, banks are adopting a more cost-effective mode of operation. Because if you look at now, the maximum yield I can get on the money I'm collecting in terms of deposits has already been capped at 14%. This 14%, this is where now I'm supposed to address all the costs and paying operating expenses, and the major aspects of operating expenses is staff cost. So if I hit on that staff cost properly, I will save a lot and I'll be able to keep, banks will be able to sort of like maintain their profitability. So that's where now banks are coming from. Solution, if you ask me, according to me, we need to relook at the interest rate cap, which will have, will give us several, will result into several things. One, credit flow back to SMEs, credit flow into the economy, and also banks also to be able to reprice, to be able to price in risk and now be able to advance credit to different segments of the market. Also in terms of treasury instrument auction in the market, now this currently what we are witnessing is purely crowding out of private sector. The government is taking all the money in the economy and now leaving private sector with nowhere to turn to, as opposed to what you are referring to, the digital lending platforms. Yeah.
Okay. Wachira, do you also agree, or rather, do you agree with him that the law should be repealed?
Yes and no. No, because you see, the idea behind the law was to enable the common man access credits. You know, there was initially there was a problem. There was the interest rates. There were very, one would argue, even unquestionable. I know I had a time. There's a time the rates were up to 28%. You know, it makes lending very expensive. So the idea behind it is noble. It's good to enable every person, even the small person in the economy chain, to access credit. And the fact that there was no way to tame the runaway interest rates, that's the reason why the law was introduced. So if the economy, if the market can come up with a way of taming the interest rates, then ideally there would be no need for the law. But as it is, I don't think the mechanisms within the economy to provide taming the interest rates. So if that can be introduced through any monetary policy, for instance, it will be good. But again, I can't argue with figures. Yeah, the figures indicate that SMEs are being starved of credit. So I guess maybe it would be time to reconsider the law.
Okay.
Yeah.
So does it mean that SMEs will ultimately lose either way? Because they repeal, the law is repealed, you have higher interest rates. The law is retained and the banks don't give you money.
Look at it this way. 2014, 2013, period before rate cap, credit was expensive, but available, as in you could get it easily. Now it's very cheap and it's not even there. So I think we have to choose which one do we want.
Yeah.
Available but expensive, or cheap but not there. And also if you look at what should I say, the issue of the rate, the runaway cost of money, when I talk of repealing, I don't mean doing away with it. I mean relaxing it a bit so that banks find a way of pricing different risk premium for different individuals. As in, we need to lengthen, it's called the corridor. Not capping it at 4% above CBR, but even say you can go even up to 18 or 20%, depending on where each individual fits in terms of the risk profile.
Okay.
Yeah.
Okay.
But if
who will supervise that?
now supervision of commercial banks will remain the sole responsibility of the central bank.
Everything, yeah.
Yeah.
Yeah, but you know, if
So
I
will
have the
they have-
option of lending to you at 18 and lending to someone else at 13, I would inclined to lend towards
towards 18, so that I make
will
more
make
money.
And you know, if you look at central bank already started another initiative for sensitizing people in terms of how how people can access information to know Bank X is issuing out loans at this %, Bank X is issuing at this %, so that even you, when you know, Kenyans are used to window shopping when they go to supermarkets only. When you're also looking for loan, you should window shop, walk around different banks and see if Bank X is pricing me at 14%. Why would Bank B price me at 18%? I would go to Bank X. So it's availability of information, and also Kenyans to be serious whenever they want to apply for. Don't restrict your bank to when you want to get a loan. Don't restrict yourself to where your bank. Walk around, get information so that you know I'm the same individual. I'm Maurice. Why is Bank A pricing me at for 13 and Bank B taking me all the way to 20%? After comparing, I go to bank that is pricing me at 13%.
Okay.
Yeah.
So what is the way forward for the banking industry now that you are foreseeing more mergers and acquisitions? What is the way forward? Washira, we can start with you. Especially, with a focus on the digital technology.
Okay. So with respect to digital technology, I think banks should definitely embrace digital technology. As I can't remember the last time I went and queued in the bank. You know, everything is either online or on my phone. Yeah, which is a good thing. So I think banks should definitely embrace this. And technology doesn't necessarily have to be viewed as a threat.
Right.
Yeah, there are ways we can embrace technology and create other opportunities that will not necessarily lead to job losses. Yeah. With respect to mergers, I think it's a good thing. I think it's good to have banks that are strong. Strong banks definitely provide or increase public confidence in the banking sector. You know, if we have banks that are able to make profit, lend to everyone, and are not shaken when another bank is placed on receivership, then it's a good thing. And it will be good for banks to definitely merge. And with mergers, we can enter different markets. We've seen banks entering into different countries. So it's definitely a good thing.
Okay.
Yeah, so I would encourage consolidation of banks.
Right. Thank you. Maurice, your final remarks.
I think
for
just
the way
speaking from
forward.
where Washira has left, for consolidation in the banking sector, so that at least we have well-established big banks that can withstand economic shocks, banks that could even finance big infrastructural projects. Remember, the reason no single bank in Kenya could finance even SGR. That's why now we keep on running around, going to China, doing offshore, as in just going around the world asking for loans. So we need banks that can even finance such projects in Kenya. And the way to do that is for consolidation, that we have big and stable banks that are well capitalized. Going forward, what I'm seeing also will happen, if with the rate cap still there, most Kenyan banks will start looking for even regional opportunities. We are likely to see Kenyan banks now looking for opportunity in other countries where the rate cap is not there. We've already seen Equity Bank, second acquisition in is it Mozambique or Congo?
I know they're moving towards down south.
Yeah, exactly.
Yeah.
And also we are likely to see most banks now focusing on opportunities that exist in the regional countries. And going forward, digitization is going to be the main agenda also for banks to be able to manage their cost. And how I look at it, it should not necessarily result into job losses. It should result into redeployment of people into other segments that need now person-to-person services in terms of how they service their customers.
All right.
Yeah.
Okay. Thank you very much, gentlemen, for that conversation.
Thank you.
That was Maurice Odwar, an investments expert, as well as Ken Washira, a commercial lawyer at Rodil, just discussing the realignments that are happening in the financial services industry with a focus on the banking industry.